Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome back to the show. Today, we have a very concise episode on the Fed Reserve and the announcements that the Fed Reserve makes. Now, they meet about 7 times a year. So typically, it's about 45-day increments between each Fed announcement where they discuss the minutes of their meeting, they discuss the vote, and they let us know, are they moving interest rates up or are they moving interest rates down? But I did want to debunk some myths and share with our listeners how exactly the Fed Reserve meeting works. Now, they appoint a large board, and there's different Federal Reserve banks around the country. Now, they come together, and when they do these Fed meetings, again, about 45 days in between each one, they will vote on what they're doing with the interest rates. And most people know that. And they hear the announcements that say we've moved the interest rates up or held them steady, maybe a quarter point up, quarter point down, half point up. In extreme volatility or crazy pandemics or markets, you might see them actually move a full point, but it's very, very rare. Now, most recently, people have thought that the Fed is the one who controls the interest rates on the long term. And I want to debunk that myth because the Fed controls the interest rate for the overnight lending rate to the banks. So this is what the banks borrow at. So when they talk about we're moving interest rates down a quarter point, well, that allows the banks to borrow that money cheaper. Or if they're moving it up, it's going to cost the bank more money. Today, I am joined in the studio by Gary Giffin. And Gary, I want to talk about how this relates specifically to real estate. We're going to talk about the bond market, and we're going to talk about how the Fed policy affects the bond market. But what's your interpretation of rates from a real estate professional and how they affect the industry?
Well, that's the buzz this week, and I'm glad you brought this up. It's very timely because most of my clients are thinking in their mind that when the Fed meets today and they make their announcement that rates will automatically just drop half a point, quarter point, whatever it is. So everybody's excited about this and how it will affect the real estate market. But in everybody's head, they're all waiting to see what the Fed Reserve meeting, it's going to be in the next, I think, few hours. So this is very timely, and I'm glad that you're bringing this one up because everybody is excited to see what will happen. And if that does drop the interest rate, then gosh, I can afford more property.
Exactly. And this is why I want to educate the listeners and explain exactly how the bond market works and how the Federal Reserve participates in the bond market. For real estate, what's most important is the 30-year mortgage and the 10-year bond. Why? Because the 10-year bond is tied to commercial assets. So when you go buy a commercial property, it's typically a 5-year, 7-year, or 10-year loan that's going to balloon that you're going to need to refinance. When you buy a residential property, you typically buy a 30-year mortgage at the end of the day, or you buy a property, it comes with a 30-year mortgage. Now, the Fed doesn't control those particular bonds unless they go and buy the bonds in the bond market, which they do. And that's called quantitative easing. So when you hear this announcement about we're moving interest rates down a half a point or a quarter point, again, that's the overnight rate that the bank is receiving. The bond market, which operates worldwide, and there's, the largest bond holders, China, Japan, even the US government and others, they're the ones that are really controlling the big bond market that has the direct impact on the 10-year or the 30-year mortgages. So for that reason, what I encourage our listeners to pay attention to is the bond market as a whole. So you can pull this up. You can look at the 30-year, the 10-year. If you want some tickers to pull up, you could pull up TYX, and that's the treasury yield for 30 years. And then you could pull up TNX. That's the interest rate for the 10-year. And you could see where those interest rates are. And based on the movement into the bond market, bonds, remember, are inverse, meaning the more money that pours into bonds, the yields or the interest goes down. So when people freak out, when the stock market gets too hot and volatile and people get out of the stock market, the mutual funds, the institutions, the insurance companies, the pension funds, they move into bonds. And when they move their money into bonds, that lowers the yield or the interest rate. So if you're looking for low interest rates, what you're really looking for is a bunch of buying in the bond market and less buying in the stock market. So that's the big thing I wanted to clear up for people. And there's something else I'm going to encourage everybody to go study on their own accord. It's called the yield curve. And the yield curve will show the curve between the overnight rate, which the Fed controls, and then the 2 year, the 5 year, the 10 year, and the 30 year bond. And in a perfect world, it looks like a mountain, right? It's going up. The overnight rate is the least. And as you go 2 years, 5 years, 10 years, 30 years into the future, you should get more interest on your money. It makes sense, right? If I loan you money for 2 years, well, then you pay this interest. But if I give you my money for 5 or 10 years, I should want more interest. So you want what's called a steepening yield curve. What's not good is a flat yield curve or an inverted yield curve. And without getting too technical, you can read all this stuff online.
Yeah, that's a good one. I'm on the gurufocus.com looking at the US Treasury yield curve updated daily, and then the Treasury yield for all the different countries. It looks like South Africa, Russia, Singapore, Japan, India, China are in the green. We're all the way at the bottom, almost the very bottom in the negatives, with Norway, Germany, Sweden, blah, 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 Canada. Yes, you don't want to be where Chile is. But anyway, that's pretty cool little website I found. You probably have other websites, but that Guru Focus looks pretty cool.
That's what we have right now. We have an inverted yield curve. So there has been many recessions that have started with an inverted yield curve. It doesn't mean every time the yield curve inverts, we're going to get a recession, but it is something to pay attention to. So Gary, as you're looking with new knowledge and understanding, your clients are out there and the stock market's been super hot the last few years. The bond market has gone the other way. People have got out of bonds. That's why we're seeing those really high interest rates. So it's not just what the Fed did, but also because stocks have been so hot. What are you seeing moving forward? What's the word on the street? Do you see people pouring more into commodities like silver and gold and hard assets like real estate? Or do you think this AI craze and the technology wave can keep bucking the trend and we're going higher, higher, and higher?
Yeah, I can tell you what I did, and this was based on us talking years ago about metals and what you should do. And I'm pretty heavy myself on real estate and metals. That's where I see my long-term retirement in both of those sectors. And I know people love stocks, and the people that can get into stocks and watch them, like yourself and Jason, and know what you're doing, and you're really educated, then that's fantastic. For me, I like the slower growth. I like to keep myself in the real estate market, in investments, and investing myself as my parents did many years ago. So my clients are asking now, is this a good time to buy? Well, do you need a home? Yes, then it's a good time to buy. And right now we're kind of stabilizing. We're seeing properties stay on the market longer. People are, trying to figure this out. They're trying to see what's going to happen next. Everybody wants to know what's going to happen next, what's going to happen with interest rates. But there's people that are out there that always need to buy real estate. So I always have my real estate hat on, and that's where I'm always sending my clients if they can afford real estate, whatever it is, land, condos, whatever it is. I'm 100% into the real estate market in all times.
Yeah, when you look at the history of the world, there's no question that land and improvements on those land on the land has outperformed any economy. Economies have come and gone, going back to biblical times when there was stock in trade and the form of the stock market back then, right? All those things came and faded away, and a new empire arose, and there was yet another economy, yet the land and the improvements, those continued to grow and grow and grow. And so, for context, back to the Fed, I just want to wrap up with this. Watch the bond market. It's so important. What the Federal Reserve has done, especially these last 20 years, is they have not only been moving that overnight rate I was discussing, which they announce at these meetings, but they have been the largest buyer in the bond market. So, in my professional opinion, it's a little bit of manipulation with the economy by them buying all the bonds, trillions of dollars of bonds to get those long-term interest rates down. And then when they want those long-term interest rates to rise, they sell those long-term bonds. So they're on both sides of the yield curve. Just know that. They are not letting the market just float. We talk about free capitalism. We talk about people being able to buy and sell and letting the market dictate true supply and demand. Well, the truth is there is serious influence. And for better, for worse, I think the Fed Reserve and the chairmans and the people that work there are doing their absolute best. They have our best interest in mind. I'm not on the conspiracy theory wave. I think these are professionals and they're economists and they're brilliant people. However, with that said, I would like to see the market actually float without the intervention of governments on the long-term bonds, because at the end of the day, they have so much power right now. And if they decide to sell off bonds, they can create another bubble and we'll rise again and we'll get out of this inflationary environment by just, overinflating and getting people in that direction. If they decide to, sell all the bonds, they can create really high interest rates really fast and create a lot of pain. So it does concentrate a lot of power with a very small amount of people. So I hope the message has blessed you. The good news is in these future episodes, we are going to dive deeper and deeper and deeper and educate our listeners on what are the big moves in the market. Is it crypto? Is it real estate? Is it stocks? Is it bonds? Is it commodities? Is it insurance? Where do you park your money so that you're not tied up trading day to day and eye bleeding nervousness, looking at stock tickers? You don't want to be doing that. You want to be able to park your money and ride a wave for several years until that trend changes. And the trends are changing right now. There's been a huge lift in technology. A lot of it at the end was driven by AI. But over the last few years, it's really just technology coming into its global markets. And now the real estate market, you should see a significant recovery because of the reversal in Fed policy. So have a blessed week, and we will catch you on the next episode as we analyze all these Fed meeting results and we analyze the stock market and where it's headed.